Hey guys, welcome to the podcast. It's another weekend edition. Thank you for joining me. Appreciate it. It's always, I guess, a little easier to do them on the weekend simply because we don't have the markets open and we can concentrate on looking at things as the screen is not flashing. So that's always nice. But thank you for joining me. Appreciate it. And for those that are new, welcome aboard. Well, we'll start out today with the S&P 500. I have received some emails from some of you basically saying, hey, the market looks toppy. It looks like it's really close to rolling over. What should we be doing? Or we're doing this. Do you agree with that? Or, and so it is an obvious time for the stock market to kind of pause at the very least or roll over completely. And so we're going to get into that and kind of how people should be playing it, I think. And that, again, not knowing who's listening to this or watching this, I can't really give you advice, but I can tell you kind of how I'm positioning myself for this. Now, we see the S&P, of course, it's been on this nice little run. I've had these lines drawn here for quite a while. An easy pullback would be something in the variety of coming back down to this line, which is kind of just connects the November low, the December low, and then would be somewhere on this low. Not that much damage if that was all we got. Now, that also would be pretty close to the 50-day moving average, which is the blue line, as you can see. So that would be something that would be very methodical, would be, not a huge correction, but something that would perhaps get some people whipsawed a little bit where they sold out this week, and then it goes down there, it bounces very quickly, and then they end up buying back higher. This market does look poised to eventually make it to the old all-time highs. And I think, we have to step back again and ask ourselves, what's the goal here? Is your goal very, very short-term trading, meaning, days, few weeks? Is your goal a long-term investor? Or is your goal more of somebody that says, hey, I want to participate in meaningful rallies and obviously miss meaningful pullbacks? Meaningful meaning 7, 10, 15% pullbacks. I want to miss those, or 20% even. I want to miss those, but I'm willing to ride through 2, 3, 4% corrections. And I think once you answer that, then you can determine how much of your portfolio you want at risk. You can determine how you want to actually manage the money. Now, some of you may have it broken up into buckets, right? You got your long-term money. A lot of people, if you watch guys on TV or people on the radio, sometimes you get the sense that they're trading their whole portfolio every day. Most of the traders I know that are on TV, and I know a lot of them that are on TV, I've talked to them off camera, most of those guys have a small portion that they kind of dedicate towards trading. They're doing things like options, they're taking bigger positions, they're really doing trades that could be 2 or 3 days long. But they have, surprisingly enough, very long-term portfolios. Some of them have mutual funds or ETFs or things they really, gold, things they don't touch. And yet, they talk about these things very negative sometimes. So they're segmenting. They're talking about short term. They're talking about their trading portfolio. And that's certainly one way to do it. But I think when you watch these shows, it tends to get your blood pumping a little bit because they make it sound like the world's coming to an end and you should be selling your whole portfolio. And obviously the odds are that you're going to do something wrong when you take those huge positions one way or another. So just keep that in mind. Now, I will say, obviously, for those people who do kind of buy and hold, while things are going well right now, and maybe your confidence is a little higher than it's been in the past few years, and you're kind of relaxing a little bit, and the market's just moving up, and you're saying, I'm not going to do any trading. Just rewind to 4 or 5 years ago to the 2008 crisis. That started out as a little correction, then it got bigger and bigger, and pretty soon the people that had bought and held lost several years worth of gains, and it's taken them several years of being invested the whole time, by the way, to get back. So is that something that's on the immediate horizon? No, I don't believe so, but is it something that's possible down the road? Certainly, with all of the debt continuing to pile up and Europe starting to, get even weaker, or I shouldn't say starting to, just getting weaker. and all the money printing around the world. So those are things that, again, from a longer term perspective, to watch out for. So if you're very comfortable in this kind of buy and hold mentality, just go back to '08. You could only go back to 2011, right, when our debt was downgraded during the summer, and within 2 weeks, the stock market had fallen perhaps 22% during that time. So I think there's room for both. Some things you buy and hold, and some things you trade really fast. For the most part, I think mostly what I do is somewhere in that medium-term range. There are certainly pockets of what I do that are shorter term, and we'll get into that in just a minute, of something that I'm buying for more short term. And then there's some things that are long term, but I would say even my long-term items that are kind of geared towards the stock market, they do have a contingent on them. They do have a caveat of when I would get out. And as long as you have that set up, then you can feel free to kind of let that vibrate a little more, that part of the portfolio. But let's look at this. I mean, if the general question is, the market looks like it's stalling out, looks like it's rolling over, should we be selling? Should we be placing very tight stops? Should we be shorting the market? I would say if you're very, very nimble, perhaps it's not a bad spot to do that. We are still stretched to the upside. Now, keep in mind that over the last, I guess it'd be maybe 10 trading days, we've essentially moved flat from point to point, right? During that time, some of these overbought things that we look at that suggest the market is too stretched, too many people leaning one direction, those have come back down. And it's only really 2 days of correction that have caused that to come back down, but they've come back down, and that's very big because the market has moved sideways, yet it's working off the overbought condition. Now, it's not to the point where it's a buy, and it's a screaming buy by any means, but it is at the point where it's working itself off a little bit. It does obviously look like it could fall further, and I wouldn't just take Friday's rebound and say, well, that was it. Not necessarily. It held at the 1,500 level. That was a little too convenient for me. I think when markets bounce at these nice round numbers, the Dow closed at 14,000. The S&P bottomed at 1,500 the other day. Those are very convenient numbers for initial places to bounce, but sometimes we fall through, right? And I think there's a good chance we might do that this time. With that said, again, zoom out. Let's figure out here what's going on in the bigger picture. In the bigger picture, there's still no real intense selling going on. Really, we had a 90% down day on Wednesday, and that day was, and then Thursday, of course, we were down a lot, kind of came back, but was still down, but not as much. Could have been worse. But Wednesday was a 90% down day, where 90% of the points lost, 90% of all the points were lost, 90% of all the volume was down volume, and those typically lead to a short-term rally, which it is, right? When we're higher now than we were on the low of Wednesday. So that's in the process, so it doesn't mean that the whole rally's ending. The whole sell-off's ending necessarily. But here's the thing. Those 90% down days, those rarely, I mean, when they come out of nowhere, for example, we're at a high, right? We were at this high, and then you get a 90% down day the next day. That's generally profit taking. That is not usually how, bear markets start. They don't just turn around like that. And so I think that we may have a correction. I think it may be mild, but here's the thing. You have to have your strategies and systems in place in advance. And I think because, again, you don't want to be looking back 20% later saying, well, boy, that correction turned into something worse. I thought it was going to be a 5%. Now it's 10%. And I'm still holding this stuff. But overall, again, in the big picture here, the supply-demand picture that I look at, and when I look at all the different internals of the market that I look at and study this, not just on the price, but on all these other conditions, I don't see a bear market developing. I don't see a major top developing. And for that, then yes, we may go through a correction, but I think it'll eventually be more of a buy the dip. So you have to ask yourself, how much of a dip before I start buying? Well, there's places, right? This is the first place that we're talking about when it maybe bounces off this line or the 50-day moving average, which would be in the high 1400s. That's not real far from where we are right now. Not a major deal, but that's something that you have to do if you have cash and you want to get invested. Now, I will say this also. If you're somebody that's fully invested, then certainly taking some profits, letting some things get stopped out, no question. But if you're kind of in the middle where you say, I've got some conservative things, some more aggressive things, I've got some cash, maybe some items that are kind of moving on their own path, then I wouldn't be doing a whole bunch still right here. I would let the market kind of prove to you that it's more in a correction. It hasn't really proven that yet. It may have flinched and said, hey, we may be going to correction, but are you wanting to be the first one to sell on that day and be wrong and then have the market race back up? Think about all the people that got stopped out at the low on Thursday, only to see it rally and then not only rally and finish higher than the low, but then come back yesterday and rally even more, with the S&P being up 13 handles, or at 1550, and almost 1% on the day. So again, the whipsaw risk is still very high right now. It's very tempting to go short, very tempting to liquidate a bunch of things that have run. And certainly, again, the market is due for a pause, but I think you have to pick out your time frames. If you're very nimble, keep your stops. You can always buy it back. If you're somebody that's looking more out for the next few months, then maybe sell those things that are the most risky and the most volatile and the most profit that's rolling over, certainly. But look to also take advantage of things that have fallen. And what we'll do is we'll go into something that I took advantage of yesterday, more for a trade. I mentioned Rackspace, RAX. It's a San Antonio-based company, hosting company, websites and big servers, so forth. That company, if we zoom out here on a weekly, you can see going back 2008, it went public, I guess, right around $10. Went all the way down to $5, and then of course the market bottomed in 2009. The thing's gone from $5, recently went up to 80. I wrote about this the other day, about when companies like Rackspace, which are growing at a really, really fast rate, the growth slows down. Watch out below, because when the growth slows down with a high multiple, the stock's going to get beaten up. And that's exactly what happened to Rackspace. The stock got up to $80. They come out, and the stock started rolling over a little bit, and actually had somebody inquire about this stock and say, hey, this has been a company that's basically every dip's been a buy. What do you think? And I said, boy, 100 PE, I see revenue decelerating. I would hold off, and perhaps when we zoom out a little bit, and for some reason this line always gets moved, but if we zoom out, maybe something in the low 50s would be a place we would buy it. Well, of course, I wasn't dreaming that it would happen as fast as it did. Remember, we were kind of like this, and saying, boy, to get down to 50, it's at $80. That's a stretch. Well, they came out with earnings and basically disappointed because their revenue growth is slowing. Is the revenue growing? Yeah, at a still fast rate, but it's coming off of growing at extremely fast to just fast. So what happens is these companies get hit really hard, and you can see over this is a daily again what's happened. Big gap down. A lot of people thought it would hold this support, which is where this line is. Kind of bounced around there for 3 days. A lot of people got in. 200-day moving average. It all kind of lined up. That looks like a perfect place, and it broke through, and it went on down. Yesterday, they lowered some of their prices. Well, that's never really a good sign, right? That means they're not getting enough business, and they have to entice more people to buy at a cheaper price. Or is it that they're going to roll out new technology and they're wanting to get rid of the old? We don't know. Bottom line is, from a fundamental standpoint, this isn't really the story you're looking for. From a technical standpoint, when a stock's gone from 80 and has had the run it's had and goes to almost 50 in about 10, 12 trading days, you got to pay attention here. So what we did is we went in and bought it early yesterday morning for more of our aggressive accounts, things that people that understand the the risks of this and also want to maybe short-term trades. This is a short-term trade for me. You can see it's come off this long line that I've drawn going back a few years. This is 2011. It bounced off there. 2012, we connect the dots, comes down and has a reversal yesterday. Big volume reversal, by the way. You can see that right here. If we zoom in, that's big reversal. Still was down on the day, but remember, this stock opened at 53.20 and closed at 54.59, and the low of the day was actually 50.75. So quite a big move. So we actually went in and bought it all day long, starting maybe at $51 all the way up. Already have a profit in it. But look, you have to determine what's the goal here. Is the goal for me to buy this company from a fundamental standpoint? I don't think so. I think it's still, I don't mind buying expensive companies if I know that the growth is still accelerating and there's a compelling reason. But they haven't proven anything yet. It's just that the stock has gotten hammered, and I think it's due for a bounce. Even if it bounces to the 200-day moving average now is $60, $60 from the low 50s, over a 10% profit. That could happen, and the stock could hit that and roll over, because now that old support is now resistance, meaning what was a floor is now a ceiling. So it could come down, bounce, hit this, and then roll over again until the company proves that this is just a temporary pause in their growth. So that's something we'll keep a stop on because it's a trade. I've identified it as a trade. Whereas if I'm buying something like, let's talk about Apple, which has obviously been in the news. This is not a trade. Some people may want to trade it. I think it's an investment. We're seeing, and I won't rehash what's happened in the last several months, but it's almost like a deleveraging process where everybody that over-owned the stock is rushing out of it. And the only analogy I could use is maybe a 6 people trying to get out of one door. Okay, they're having to go out single file. The people in the back are saying, hurry up, we got to get out of here. Maybe there's a fire, and everybody's pushing, and so people are going a little faster and frantic than they normally would. At some point, that flow slows down, calmer heads prevail, the stock is reasonably valued, and it gets out of the spotlight. This was a stock that was frankly used as the default for people's money. Hedge funds were buying this when they get cash into the accounts. They would buy Apple and say, well, it's always going to outperform the market. We know if the market goes down, Apple's going to go with it, but probably outperform. It's going to outperform on the way up. And why wouldn't we? And so all that money's coming out. People that owned it on margin are selling. Mutual funds that had it as their biggest holding are selling. Individuals that thought it could never go down are panicking and selling. And so, but what's left after all of that? A company with $130 billion of cash, growing. But here's the thing I think it's really going to turn the stock. First of all, from a technical standpoint, this is the 50-day moving average, this blue line coming down. And I've drawn this trend line too. It's kind of been stair-stepping down. Thought maybe it'd get up to the 500 and then roll over. It didn't. If it breaks above that, then you've got a nice technical formation where maybe the bottom is in and you start to stair-step up a little bit. I think there's also a very good chance that it could, again, and this may take a little bit of time, work its way out, break out of there, maybe come down, and then head up to a declining 200-day moving average, which may be in the 550 range, and then maybe that's the time to say, okay, I really need to make a decision here. Am I willing to hold this thing to the death, or do I think there's more downside and my capital could be used elsewhere? And I think if you do that, you will make a good decision at that point. And if it breaks on through there, fantastic. But I think that's kind of maybe the target over the next couple of 2-3 months. But here's the thing from a fundamental standpoint, I think it's going to have to happen for this company to really turn the stock around and get that momentum back, because I don't think it's lost yet. But I think it's going to have to either come out with a product that is a wow, which the iPhone 5 was not. They're going to have to come up with some kind of wow product that really makes people say, I've got to have that. Whether it's a new phone, whether it's a new iPad, whether it's a watch, which I don't think that's going to be the deal. I think maybe it is the something with the TV, and I think that's something that could really, be a game changer, and really introduce a new category. That's one thing they could do. The other thing they could do is obviously increase their margins, because their margins have been decreasing a little bit. They're still fantastic, but they're decreasing. A lot of people buy Apple based on those margins expanding and being super high, and if that reaccelerates back up, that could get the stock going. And then the third thing, obviously, is the use of cash. I don't necessarily think paying it out to shareholders, although that's the pressure right now, is something I want done as a shareholder. I don't want the cash back. I just get taxed at a very high rate. What I want is I want them to either buy stock back and tell the market, hey, we think out of anything we could do, instead of going and buying another company, we're going to go buy our own stock because it's so darn cheap. That's an option. Or could they go acquire somebody? Those are some things they could do with their cash. So I think those are the three fundamental things I can get it to turn around. Other than that, right now it's just kind of languishing, and I don't necessarily think it's in the free fall it was, but I do think that it may still have this stair step down, or at least sideways for a while between 4 and 500, 425 to 500, until you see something like that. So that's a fundamental buy. You see, that's a fundamental buy. Charts aren't as important on that particular stock for me. Rackspace is more of a company that is more of a trade. Okay, and again, I could maybe argue some fundamental things, but let's look at the reason it's falling. Overpriced stock, decline in revenue growth. Case closed. Okay, and you may say, well, why would you even buy something like that? Because it's still a company that is respected. It's got a track record. It's got great management. They're doing very important things. And, again, even bad stocks bounce. And this is a stock that is broken, obviously. It's not a broken company necessarily, but it could bounce. And when it bounces, that's what we're trying to capture with that piece of the portfolio. Okay, we take a look at gold. Obviously, we talked about this. I think I wrote an article earlier in the week about gold. And, you can see it was kind of riding down this 50-day moving average, banged into it here, banged into it here, banged into it here, fell apart. It looked like it may be kind of forming this triangle. It could break out to the upside. It didn't. It broke on through. Now we're at a spot where very, very oversold. Reversed, had a couple of up days here, kind of in this 150 range on GLD. And look, I think it can rally. I think the reasons it's fallen temporarily are probably good ones. Given that economic growth was better than expected, there's no real fear out there right now. But again, let's stand back and think about this from the big picture. Why has gold run up so much? It started with Greenspan, Bernanke, this money printing, devaluing the dollar, the race to debase it around the world. That hasn't ended, right? That has not ended. And so I think there's still a place in the portfolio for gold. But look, I'm not married to it, and B, it's a very, very small portion of what I do. So I don't lose any sleep at night when gold moves, 2%. And I just don't think necessarily the bull market in gold is over yet. And we've had situations like this in the past where gold has really freaked people out, and everybody's questioned the sell-off. And I'm not a gold bug by any means. I think it should be eye-opening for people who have been buying coins and bars and storing them in the backyard, and buying 12 different gold stocks. There's more to life than the metals market. But a lot of people felt like this is their saving grace, and they're finding out it's not. It's not. Actually, lo and behold, stocks have worked. So be careful when you overload too much. But I think gold is gold's oversold. It's due for a bounce. Once it bounces, then you can determine, okay, do I have too much of it? Do I need to sell it? Or you may just say, hey, I know this thing is kind of a zero correlation piece of the portfolio. I'm going to leave it through thick and thin and just hold on to it. As long as I'm seeing the same things today that I saw a year ago and 5 years ago and 10 years ago from governments around the world with paper money, I'm going to hold it. That may be your decision. That's fine. But I think you'll have a better spot to sell it. It may only be at 160 on GLD, but you're going to have a better spot to sell it, I think. All right, guys, I'm going to go ahead and wrap it up. Before we do get going here, though, I did want to touch on Facebook real quick. I tweeted out a while back. Facebook has been pretty strong, obviously, since the fall. Fundamentally, I still really struggle with purchasing this company. I've never purchased it. It's been on my radar to watch and see how it's acting. I pointed out that there could have been a possible head and shoulders, and I think that's exactly what might be developing here. When you see the first shoulder, you see the head, and then you see potentially the second shoulder here. Where this line would be the neckline, and it's real close to breaking on through and heading down. if that were to happen, the next thing you would look for is the support at where I drew it here, which would be right in here, because it would break through. That would be the old line. That may be an interesting buy at that point. Then you're talking about a stock that has come from $33 down to, I don't know what that would be, $22. That's not a bad. That's a 33% drop. Then perhaps that's the trade, and you buy on something like that. So this may be the area we kind of target, but it's something I'm watching. It's just, again, it's really tough, as I mentioned earlier, to go in there and buy companies that you're still questioning where their growth is going to come from. And a lot of people obviously think mobile advertising is where Facebook's going to go. They seem to have gained a little more confidence, at least the street has, in their message. And I think that's why it was going down so fast earlier. When it went, obviously when it IPO'd, it was overdone, overhyped. But during this summer sell-off, that was because they weren't telling the street, how are you going to get revenue? And I think they're doing a better job of it now, which is why you've seen it rally. But it's at an inflection point, as far as I'm concerned, where it's either going to bounce from this level, or if it does break, I think you're looking at the low 20s. So for those of you who like to trade Facebook, maybe want to own it for the first time, take a look at it. I don't know if I'll ever own it, but it's one of those stocks I think you have to watch. So I know this podcast went on a little longer than usual. Probably one of my favorite areas still is the financial space. But look, the overall market, again, if you want to take profits, take some profits. You can buy them back. You may risk missing some upside, but I still think it's very tough to go short right now, because the overall supply-demand picture in this market is showing that rallies are shallow and demand comes back in. And when there are sell-offs, it's just because the buyers are kind of pausing. The people wanting to get in are pausing, and that's not stuff that makes a market go much lower. But the biggest caveat to everything I've said in this podcast is potentially the sequestration, right? And the market's not really acting like it's a big deal. It's kind of ignoring it, almost like it did the fiscal cliff. But that's something we've got in the next couple of weeks here. So watch for volatility, and perhaps err on the side of caution in the next couple of weeks until we maybe get that behind us. All right, have a wonderful weekend. Hey, don't forget eggerscapital.com, twitter.com/Carl Eggers. Make sure you check that out. Google+, Facebook. We're on iTunes. So we're all there for you. Appreciate it, and have a great rest of the weekend.